Ever wondered how people with bad credit get approved for American Express cards? What if I told you there's a little-known back door into the Amex ecosystem? Tired of getting denied for premium cards despite having decent income? I'm Bernard, and I turn my financial research into fun videos. After spending countless hours analyzing credit-building strategies and bank approval patterns, I discovered something fascinating about how premium card issuers actually evaluate applications. Most people think getting approved for American Express requires perfect credit and six-figure income. The reality is far more interesting. Banks care more about your relationship with them than your credit score. And I've uncovered exactly how to build that relationship even with less than perfect credit. The traditional advice about credit building is missing crucial pieces. While everyone talks about credit scores and income requirements, they're overlooking the specific account combinations and timing strategies that actually matter for approval. What I'm about to share completely changed my understanding of how premium credit cards work. These strategies helped me go from getting denied for basic cards to carrying multiple American Express cards with substantial credit limits. Here's what you'll learn today. How to get your first American Express card even if your credit score is below 700. The exact application sequence that minimizes credit inquiries even if you've been denied before. A proven strategy to maintain high credit limits even if you rarely use your cards. The optimal credit utilization range that maximizes your score even if you're carrying balances. Advanced techniques for rapidly accumulating reward points while building your credit profile. Let's start with something most people don't know about American Express. While everyone's trying to get approved for their credit cards, there's actually a much easier way in through their banking products. This changed everything about how I approach credit building. The secret lies in American Express's business checking account. Now, you might be thinking, but I don't have a business, or my credit isn't good enough for that. Here's the fascinating part. American Express doesn't check your credit for their business checking account. All you need is an EIN number, which you can get online in minutes. They'll send you a sleek business debit card that starts building your relationship with them immediately. Imagine this scenario. Sarah, a freelance graphic designer, kept getting denied for premium credit cards despite making good money. Her credit wasn't terrible, but previous financial struggles left her with a 650 credit score. Instead of giving up, she opened an American Express business checking account for her design work. Within 3 months, she started receiving pre-qualified offers for their credit cards. Why? Because she proved she could manage a banking relationship before ever applying for credit. But here's where it gets really interesting. While you have this business checking account, you should also open their high-yield savings account. Currently, it's paying about 4.5% annually. Think about what's happening here. You're not just building a banking relationship, you're actually earning solid returns while doing it. This combination shows American Express you're a serious customer before you ever apply for credit. Want to know something fascinating about how banks evaluate your relationship? They look at your total banking footprint, not just your credit history. Every deposit, every transfer, every interaction builds your profile. But here's the key most people miss. Consistency matters more than size. Regular $500 deposits can be more valuable than sporadic $5,000 ones. Now let me share something crucial about timing your applications. Most people make a costly mistake here that results in unnecessary credit inquiries. They rush to apply for business credit cards first, thinking it won't affect their personal credit. But here's the game-changing insight. If you apply for an American Express business card first, you'll get a hard inquiry. Then, when you want their personal card later, you'll get another inquiry. Let me show you how this plays out in real life. Think about a small business owner who applies for the business gold card in January. They get approved but take a hard inquiry. In March, they want the personal platinum card. That's another inquiry. But if they had applied for the personal card first, they could have avoided that second inquiry entirely. Why does this matter? Because each inquiry can impact your credit score for up to 2 years. Want to know the most powerful part? There's a specific sequence that can cut those inquiries in half. Apply for the personal card first. Once you're approved, American Express typically won't pull your credit again for future cards. This means you can get their business cards later without additional inquiries. This single strategy could save you valuable credit score points. Let's talk about something that's costing people their high credit limits without them even knowing it. PenFed Credit Union, one of the top 3 credit unions in the country, is making a major change that nobody's talking about. They're actively monitoring spending patterns across all your cards, not just theirs. If you have a high limit card with them but aren't using it while spending on other cards, they're starting to slash those limits dramatically. Here's a real-world example of how this affects people. A customer with a $15,000 limit barely used their PenFed card for 6 months while regularly using other cards. PenFed saw this pattern and reduced their limit to $1,000 without warning. But here's the solution. You need to maintain strategic activity on these cards. This doesn't mean carrying big balances. Instead, you want to hit what I call the golden zone of credit utilization. Through extensive research, I've discovered that FICO scores actually peak when your utilization falls between 1% and 6%. Not 0% like many people think, and definitely not the 30% that's commonly advised. But why this specific range? It shows lenders you're actively using credit while maintaining strong financial discipline. This is where the A1 method comes into play. Instead of trying to juggle utilization across all your cards, keep all cards at 0 except one. On that single card, maintain a tiny balance that puts your overall utilization in that 1-6% sweet spot. Think about it this way. If you have $50,000 in total credit limits, keeping a $500, $3,000 balance on one card while zeroing out the rest puts you in the perfect range. Here's a practical way to implement this. Find a small monthly bill you already pay, like a streaming service or gym membership. Put it on one card and set up autopay. This ensures you're always showing some utilization without having to think about it. But remember, timing matters here too. Card issuers typically report your balance to credit bureaus on your statement date, not your due date. Consider this scenario. You have 5 credit cards with a combined limit of $30,000. By putting your $75 monthly gym membership on one card and paying everything else in full, you maintain a perfect 3% utilization rate. But here's the key detail. Make sure that charge posts before your statement date to ensure it's reported to the credit bureaus. Let's dive into something really powerful, maximizing rewards while building credit. Many people think you need to spend more money to earn significant rewards, but that's not true. The secret lies in redirecting spending you're already doing in the most strategic way possible. Think about this scenario. A family spends $1,000 monthly on groceries, $200 on gas, and $300 on utilities. By matching these expenses with the right cards, they could earn triple points on groceries, double points on gas, and still get base points on utilities. That's an extra 400 points annually without spending an extra dollar. But here's what most people miss: timing these applications to maximize sign-up bonuses. Have you ever wondered why some people seem to rack up massive amounts of points while spending the same amount as you? The difference often comes down to strategic timing and category optimization. For example, many premium cards offer enhanced rewards in the fourth quarter for holiday shopping. Planning your large purchases around these bonus periods can dramatically increase your returns. Speaking of travel rewards, let me share a strategy that's particularly valuable right now. The Southwest Companion Pass is essentially buy one, get one free on all flights for a year, but most people don't know how to earn it efficiently. By combining the personal and business Southwest cards, you can accumulate the required 400 points much faster than through flying alone. Here's how this looks in practice. Let's say you're planning to book several flights for business trips next quarter. Instead of booking them now, you could time your card applications to ensure those purchases count toward your Companion Pass qualification. Once qualified, every flight you book for the rest of the year essentially becomes a 2-for-1 deal. But what about building and maintaining credit through all of this? This is where smart account management becomes crucial. Every time you open a new rewards card, you need to have a clear plan for meeting the minimum spend requirement without overextending yourself. Have you considered how you'll track all these different due dates and payment requirements? Remember earlier when we talked about building relationships with banks? This is where it all comes together. Once you've established these relationships, you're not just building credit anymore, you're building a complete financial system that works for you. The business checking account leads to credit cards, which lead to rewards, which lead to travel opportunities, all while maintaining and improving your credit profile. Consider this powerful combination. You start with a business checking account, add a high-yield savings account for your emergency fund, then strategically time your credit card applications. Each component strengthens your overall banking relationship while serving a specific financial purpose. But here's the question most people never ask: how do you maintain all these accounts efficiently? The answer lies in automation and systems. Set up automatic payments for every card, but not just the minimum payment. Set them to pay in full. Create calendar reminders for when to request credit limit increases, typically every 6 months for most banks. Monitor your credit reports regularly for changes and opportunities. Here's a strategic approach many people overlook. Consider your statement closing dates as important as your due dates. Why? Because the balance on your statement closing date is what gets reported to credit bureaus. By paying your cards down before this date, you can ensure optimal utilization reporting even if you're using your cards heavily. The key to making all of this work is patience and precision. Don't rush to apply for every card you see. Instead, build these banking relationships strategically. Use your cards purposefully. And always keep your long-term financial goals in mind. Ask yourself, are you building credit just to have a high score, or are you building it to create real financial opportunities? Let me share one final insight about credit building that most people miss. It's not just about what you do, it's about when you do it. The same action, like requesting a credit limit increase, can have dramatically different results depending on your timing. Have you noticed how some months your credit score seems more responsive to changes than others? Want to take this even further? Check the resources in the description and pinned comment for detailed breakdowns of each strategy we covered today. These tools will help you implement everything we've discussed in a way that works for your specific situation. Remember, building great credit isn't about finding shortcuts. It's about understanding how the system works and using that knowledge to your advantage.